From a net return perspective, you should theoretically be better off in the CVs because the management fees are lower.
Hi everyone, thank you for tuning in to the exciting new mini-series, Women of Secondaries, which is part of a larger SecLink Podcast initiative produced by the prominent news and data platform Secondary Link and hosted by yours truly. My name is Kristina Kulikova. I'm the VP of LP Advisory at Setter Capital, and I'm absolutely privileged to host Women of Secondaries, where we cast light on the incredible powerhouse women driving this market, not only showcasing their business persona, which you may already be familiar with, but also showcasing their unique and sometimes surprising personalities. We also take a deep dive into their perspectives on a variety of pertinent market topics, and last but not least, showcase some incredible performance highlights which are both inspiring and informative. On this episode, we're thrilled and honored to have not only a fellow Torontonian, which I'm really excited about, but also an absolute powerhouse of a woman, a seasoned industry professional with over 13 years of experience in the secondary market, a talented investor, and an MD of one of Canada's first secondary funds to focus on the GP-led market. Welcome, the MD of Morningside Capital Management, Tori Buffery.
Hello.
Hi, Tori.
Hi, how are you?
We're great. So glad to have you.
Oh, I'm so excited to be here. Thanks for having me.
That's awesome. And I can't say I love this weather in Toronto today, but we're going to make it all exciting nonetheless.
Exactly. And April showers bring May flowers. So there you go.
That's right. That's right. Well, look, before we jump into the key industry topics we have planned for today, I'd love for our audience to get to know you a little bit better. So maybe we can start there. Maybe a brief background on your role at Morningside, your transition from being at CPP on the secondaries team, and how Morningside happened, and then perhaps how you ended up in secondaries in general.
Yeah, happy to. So as you pointed out in the intro, I'm from Toronto, fellow Torontonian. I started my career in investment banking at BMO, then went over to CPP to do funds and secondaries. And secondaries was a very new thing for the pension plan. Previously, CPP had been investing in secondaries funds and then decided they were in a lot of the other funds on a primary basis. They would be a natural buyer for fund positions themselves. So when I joined, it was really their first foray directly into the secondaries market. Also, when I joined, it was January 2010, probably the worst market to be fundraising. So instead of working on a bunch of fund commitments, I worked on secondaries. And it was the best time. You would know better than me, but I feel safe saying those times are probably behind us. Some of the discounts you could get were pretty incredible. Not a lot of competition in the secondaries market. So it was a really successful start to them pursuing the strategy. And then in end of 2015, I was chatting with my now fellow business partner, Henry, about joining him at a firm focused exclusively on GP-led transactions. So took the plunge, joined January 2016 at Morningside, and it's been a crazy 8 years in the secondaries market.
Yeah, it's probably, you guys were probably one of the first to focus exclusively on GP-led market, which, pre-GFC just simply didn't exist. And I feel like it's really post the GFC that it started to have its incumbency. And then, going from less than 6% of market of overall market volume in like early 2010s to now almost half. I mean, that's just an exciting and thrilling growth that I'm sure you'd love being part of.
Yeah. And I got to say, our marketing was very bad initially. I think whoever coined GP-leds, thank you, because it wasn't us. And we used to go around calling them fund restructurings, calling GPs and asking if they wanted to restructure a fund. Is pretty crazy actually to think about now, but we still got deals done. So clearly there's appetite for these types of transactions in the market.
And there was a need early on, and it's just exacerbated, right, as we sort of roll forward. No, that's awesome. And I think now you're probably in a best growth spot in secondary. So that's going to be exciting to see. And I guess currently, now that you're at Morningside, a couple of rapid fire questions for you, just before we get to really kind of the meat and potatoes. What's the favorite part of your job right now?
I love getting a new deal. It's just like opening a little present because there's so many layers to look at. I love seeing all the elements. Who's the GP? What are they doing? Why are they doing this? What's the asset? It's kind of like putting together a little story and getting excited about the potential to kind of go into a new transaction. So yeah, when I see the email come through or the call, that's probably the favorite part of my job.
It's like, did you used to build a lot of puzzles as a kid
I
and
still
putting
love
the pieces
puzzles,
together?
actually. Yes, my children are like not quite old enough, but I'm always trying to get them to do puzzles, and then they walk away, and I'm doing them by myself. So yes,
That's awesome.
that tracks
It can be
actually.
akin to that for sure.
Yeah.
And so I guess in looking at both sides of the coin, I got to ask, what is the least favorite part of your job?
Oh my gosh. Well, we're a small firm and we're a team of 9 people, and we try to pull in resources as much as we can, but we kind of have to do it all. And so even when we raised our first commingle fund in 2022, it was just kind of drinking from the fire hose, which I'm thankful now that I understand all the elements, but it can be kind of nerve wracking when you're doing something for the first time, and you're trying to understand something you didn't know before. And some of the aspects of the job are not as fun, but high risk. So you really want to get them right. And so, understanding like tax and all these things is not my area. And I need to kind of know enough to be dangerous, but it is tough when you don't fully understand. But there's repercussions if you get those things wrong. So I do find that actually is a big stressor in my life. But hopefully, as we grow and gain more resources, I'll be able to focus on the areas where I'm best placed to add value.
Yeah, and I guess it's always wearing many different hats and at the same time prioritizing the resources and the time that you have on hand, right, to do sort of the most value add, which tends to be the trickiest.
Yeah, for sure.
And so given all that workload and you're a mom, it sounds like young kids, what time do you wake up?
Oh, great question. So my kids are great sleepers. Thankfully, I'm very thankful
Fantastic.
for this. So they wake up at 7:15. Their lights change color, and then they run out like mama. So I try to get a head start on them. So I usually wake up minimum like 6:45, 7, just so I can stare at the wall for 15 minutes before the chaos starts. But
Before you start
often,
wearing all your hats.
yeah, exactly. Before it begins. But often, if I'm thinking about something, I'll just kind of wake up early. And I do my best thinking. Actually, we have a spin bike. So I get on the spin bike and I think about things. So those are the best days. And then I feel like I've had some awake time before the mama begins for the day.
Got it. Well, that's hopefully you're not too exhausted by the time your day is done. And I guess in thinking through your career, whether it be at CPP or now at Morningside or even your earlier relationships, what do you think has been your most influential relationship that's really sort of formed your interest, whether it be in secondaries or in deal making or efficiency, what have you? Just as you think through, who's the most influential persona?
Yeah, it's such a good question. It's going to be kind of a cheesy answer, but it's hard when you start your own firm and you're just always being told no, like really truly. I mean, you understand, you work in a similar industry, and there's someone we have who's a senior advisor to us who just when you're having a tough time and you're trying to get things done, he just always believed in us, and he went into a deal with us, was super happy, and became our senior advisor. And he's made just great intros, and meet with him kind of on a quarterly basis. And he's just someone who always is there to kind of listen and believe in us, because that is the most powerful thing you need kind of on those tough days. And then I do have a group of people that I do call on, who just, as I said, just believe in me and believe in my strengths. And there's some days where I just really need to hear that more than anything else. And I hope those people know how much they mean to me, because at the end of the day, you have to be in charge of your own destiny. I really think, but sometimes you need a little bit of motivation and a hug and some love when times are tough.
Yeah, it's true. And I think I read somewhere, I can't remember if it was in a book or in a magazine, but it said all it takes for you to be successful is have one person believe in you. And that one person believing in you drives you mountains, right? To move mountains. So I'm glad that you had that person by your side as well. And it sounds like they're still involved in the business. Well, thanks for playing along with the rapid fire part of the chat. And so now let's get into maybe the meat and potatoes, and obviously your expertise in the GP-led space. And, as we've seen the market grow, I think back in 2017 was probably the first CV that was done, if I'm not mistaken. And it was, more back in the day, it was more around challenged assets, maybe challenged GPs, whereas now I feel like the story has completely flipped to being much more CVs done on performing assets, and that's kind of an easier conversation to have and something that LPs are much more open to and can understand probably better. So I'd love to kind of get into your expertise in the space, and I understand Morningside does both multi-asset deals, single asset deals, and yourself, you mostly focus on the single asset part of the business. And so I'd love to learn whether that was a personal choice or whether there's a particular reason you gravitate towards that, and why.
Yeah. So, you're exactly right. We aren't, I focus on single asset secondaries. We didn't kind of starting Morningside wanting to do single asset secondaries because it wasn't a thing. A lot of what we've done in the past is actually pref equity solutions. So we work with GPs to provide them financing for whatever they need to do in their portfolio. And as part of that, we would look at multi-asset deals. We would get kind of the same calls that other people got, talking to lots of GPs. And I remember getting a call for a single asset deal, and it was with a GP that I knew super well from my CPP days. And just something kind of clicked. And we started to see more of these transactions. We actually personally put our money into this deal. We liked it so much. And saw that there was a real opportunity, as you said, to work with actually GPs that were established, that didn't need to do this, that were doing this because they wanted to hold on to their trophy assets for longer. And if you look at the Canadian market, at a lot of the investors that exist, they're not the CPPs of the world. They're kind of the smaller groups that don't have 10 million minimum to put in a high profile GP. And so we saw this product as an opportunity to actually gain exposure to those managers, and not only those managers, but helping them invest with the managers in their own favorite assets that they already owned and were doubling down on. So we just saw it as such a opportunity to provide to the Canadian market. I myself am an investor in this type of business as well. So, and looking back as well, it was such a great match with our CPP background as well. When I joined CPP, as I said, I kind of fell into secondaries initially, but then I did work on a lot of fund investing. I spent 4 years in the UK working on fund investing. And so it was an opportunity for me to kind of come back to the managers that I used to cover and work with them again, but also put to work the skill set that I learned doing GP-leds at Morningside. So I love that it's a mishmash of both. And I really do fully believe in this product. I think the return potential is fantastic. I think there's very good downside protection. So as I started talking about this, it became very clear that I really love this product and was able to convince other people as well, which led to kind of our first commingle fund focused exclusively on this space, which we raised 2 years ago.
That's awesome, and I'm sure it's continued its success, given that you're still there and you're still focused on single asset deals. And so, what is, maybe if I you put on your looking glass and into the future and prognosis for this year, what do you think is the vertical where we're going to see the most amount of single asset deals being done? Let's say, for the balance of 2024 and focusing in North America or Canada or the US.
Yeah, I think this year we're going to see a very busy second half. And I hope you agree with me because you see this market as well. It's been quiet kind of the first part of the year. I think a lot of people have been watching the market. The thing with the single asset deals is a GP isn't really forced to do them. So they're not going to go to market if the conditions aren't right. So I think it's been a funny market, but I think a lot of people are getting ready to come to market in the second half of the year. So I think we're going to see a lot of single asset and probably multi-asset GP-led processes come out very soon. I do think as well, we're going to see a lot of kind of larger GPs come to market as well. A lot of money is kind of tied up in funds that are now approaching their 5-year mark. And a number of the large GPs, their portfolio companies are IPO candidates. And, not really a great time to IPO right now. And so I think that's been a really big driver, a lot of the deal flow we see. So I think we're going to see some big assets kind of come to market. And then in terms of industry verticals, I get this question from investors. I think of us as being kind of industry agnostic, but we like companies that have a real product you can kind of touch and feel and investigate, and also have an operating history. And so I feel that other secondaries firms have kind of the same preference as well. So we've seen a lot in the industrial space, because again, real companies you can touch and feel that have been around for a long time. Healthcare is another area that I think people are really interested in. We've seen a bunch of deals in the electrification kind of vertical, just playing to the trend of electrification. You might see some defense spending companies as well, but it's really about assets that have a known track record that should continue to do the same kind of the next 5 years. So you do tend to get kind of stuff that is, I say this in the nicest way, really boring companies.
But something tangible that, as you said, you can touch and feel. So, maybe if we're looking at like AI or quantum computing or something, that's probably decades away until we see massive volume in those companies.
Yeah,
I would think, for at least
CVs. Exactly. And when we look at a transaction, I want to feel comfortable the GP is doing this because they know the company and want another bite of the apple. No other reason, right? So I need to see some sort of operating history, some reason that they want to keep doing this. And so the companies do need to have been held for a certain number of years, to your point. And then within geographies, which I didn't answer your question on, we haven't seen too much in Canada. We did actually, within the last 16 deals we've done, one is Canadian. We have one Canadian asset, but the Canadian market is just a younger market, right? So as it matures, we might see some more come out of it. About 2/3 of our deals have just been US. Between US and Europe, we're pretty agnostic. But I'd say we would probably expect that in the next 5 years, like that kind of mix, and then maybe one or two in Canada.
Yeah. The Canadian market across the board, I think, is obviously a little bit more nascent than something that's like the US or Europe. Now, a little bit on a side note, just in terms of performance of CVs and sort of single asset deals. So there's been some controversy around, are we going to continue to see the continuation of sort of single asset deals or CVs if the returns actually don't exceed those of traditional buyout funds? And it's nice to see that there's been reports of some CVs that were done a couple of years ago that they're actually generating the strong returns that were anticipated. And I think that's, on the trajectory to continue. But there is concern about, is that capital going to shift away from buyout funds if the returns just aren't there?
Yeah. I mean, it's something to think about. I mean, there was a report done recently that showed single asset CVs perform at the level of buyout funds, but with lower risk. And when I look at our own investors, a lot of them care about returns, but they almost care a bit more about capital preservation. And when you look at the CV strategy, it's about buying assets that are known. You're past your first 100 days. The owner of that asset wants to keep personally investing as well. And so that provides a lot of comfort versus going blind into kind of a new asset on day one. So I definitely buy that. It makes sense. It's nice that the data is starting to back it up. The other thing, and look, my fund is focused exclusively on single assets. So if you're a secondaries firm, I know some of our competitors will mix that in to the fund, but for us, it's focused solely on single assets, but you're also getting GP diversification. So an investor would invest with us and get a every single year kind of 8 to 10 different GP investments. And those are single assets, but then over time, they're building a really diversified portfolio of companies and GPs. So that's the other level of diversification that they're getting. And that makes them feel comfortable from a risk return perspective.
And I guess one can argue that there's a little bit of more careful selection when it comes to CVs because you have that history, right? So you're digesting a lot more information based on historicals, GP's involvement, et cetera. And so, yeah, I guess it's a little bit more careful selection bias.
Yeah. The other thing is from a net return perspective, you should theoretically be better off in the CVs because the management fees are lower. You're not paying a 2% fee on a commitment. You're paying a fee on invested capital that's often less than 100 basis points. So a lot of your capital isn't being put towards fees. And then the carry is also on a ratchet structure. So instead of paying 20% carry over an 8%, you work up to that. So in many cases, a GP has to return a 20% net to get their 20% carry. And so if you compare a buyout fund that returns net 9%, and you look at a CV fund that's done 9%, like that won't have paid as much carry, right? Whereas the buyout fund theoretically could be in the carry and paying that out. So on a net basis, you're better off. And look, it's better alignment as well. And then in our own fund, we actually charge fees on invested capital. We don't charge fees on committed capital. And we have a whole fund waterfall as well. So for us to actually make money on our fund, our investors need to have received all of their capital back, plus the preferred return. So we really need to be in a good place until we start getting paid. So on a net basis, they should theoretically be better off.
And that's actually a perfect segue into, there's a lot of talk about capitalization coming into the market from the private wealth channel, and whether it's the 40 Act funds that are being set up or whatnot. And I feel like there's a lot of interest from the private wealth market. What do you think are the components that might drive private wealth into specifically single asset, GP-led deals or Morningside fund, for example?
Yeah, it's something we think about a lot, actually. I think this is a product that's very well suited to that market because you're getting into the upper echelons of private equity names you wouldn't have access to, and you wouldn't be able to build a diversified portfolio up. You've seen some firms team up with some of the banks and the wealth channels here, but they're single names, right? So yes, you're getting access to secondaries, but maybe just one firm. Whereas we're able to build a portfolio of kind of all the marquee private equity fund names using kind of single asset CVs as a tool. So I do think this is a market that's very well suited. I think if you're going to go after that market, you have to have a really strong kind of back office as well and strong resources to actually cater to those clients. So it's something for us that's probably aspirational for right now, but I do think this product would make a lot of sense for that market.
Yeah, especially your comment on, the net risk that's potentially a little bit lower and the preservation of capital that I think in some cases is more impactful for the private wealth channel.
Yeah, and I think I have kind of strong views on this, some of which may or may not be kind of controversial, but you see a lot of open pooled vehicles, which I think are interesting, but are problematic in an asset class that isn't liquid, right? And so I think that there's some of the structures that have been put together probably aren't perfect. Our structure was designed, and it's still not perfect. We're still kind of thinking of tweaking it all along the way, but we have a 1-year investment period and a 5-year term and fees on invested capital. Yeah, so it's some days I regret it because it's a lot of work, but it's like you're not handing over a check for kind of 5 years where your capital is going to be called. You kind of can decide every year if you want to re-up or not. And then instead of the 10-year hold period, it's still 5. Look, it's still a lockup. And then the fees on invested capital really as well help with that J curve kind of concept too, because it's hard when you go into a fund, even where at CPP, you commit to a fund. What do you do with your unfunded? That's CPP, we invest in a pool, but then the first few years you're heavily negative IRR because you're just paying fees and no capital is being created yet. And I think that's hard as a regular investor that isn't even entrenched in this, where you get your capital account statement and you're minus 100% IRR kind of the first quarter, but you signed up for 20% plus net returns, right? So I think it's hard. So we did try to really sit down and think, how can we make the structure better than what it's typically been, and also better than what we've kind of seen people take a stab at in the market. And as I said, there's probably other ways we can think about tweaking it, but if you have any ideas, let me know. But we try to really think creatively about like, what are the biggest barriers to private equity, and how can we make it better?
Well, I think a big, probably, I don't know if you've noticed this on the fundraising side as you look to bring in capital for the product, but my guess would be that now with GP-led and sort of CV deals becoming a little bit more of a norm for GPs, particularly for their trophy assets, there's more conviction that there's going to be strong returns to be made, versus maybe in the past where it was more around the challenged assets that you weren't sure which direction they were going to go in, whether there was alignment at the CV level, right? And so I don't know if you've directly noticed an impact in the ease for fundraising, but I'm just curious if that has actually been the case as the industry normalizes that liquidity option.
Honestly, I feel like it was when you said you worked on restructurings or GP leds, you kind of felt like immediately judged a little bit because people just assumed you were. Yeah, I know. I was like, I would say that and then kind of hide. People just thought you were enabling zombie funds, right? And now I can hold my head up high and say I work on GP leds. And by the way, the last time I spoke, I did too, and I just didn't tell you. But yeah, no, it definitely helps a lot. And having some big names also out fundraising in the market does actually help us a little bit. We have a very high profile person who worked with us at CPP that started a big firm, and he's done a great job educating the market. And for now, there's lots of space for all of us. So from a competition perspective, I'm happy for people to know that brand and benefit from education in the market. But that's actually gone a long way too, to helping explain these transactions a little bit more. And then, when you see big GP names in the news doing these transactions, that not only helps with LP perceptions, but other GPs see that, right? And then they want to go and learn about these transactions as well. Like we used to spend the first 3 meetings with the GP explaining how this was going to work and convincing them that it could be good. And now they call us and they know what it is already. So it makes my job much easier for sure, from a fundraising perspective, but also from a sourcing perspective.
And execution, it's easier and probably quicker to meet your 1-year investment period target.
Yeah, for
as
sure,
well.
For sure.
Yeah. And I mean, the industry is big now, right, compared to its nascency, 10, 15 years ago. And there's a lot more firms coming up. And like AXA just acquired W Capital to sort of capitalize on that GP-led space. And I think that just speaks to the strength of the market. And so, but if you're thinking about your marketplace, whether it's in Canada or let's say North America, is there a particular firm that you view as kind of the closest competitor to you guys?
Oh,
it's a trick question a little bit.
There's firms that I aspire to that wouldn't think I am their competition.
Fair enough. We'd love to hear it anyway.
But there's a few firms, and then there's firms that do like something very similar to us. So and it's funny because we don't compete on deals yet. The market really is big enough, and we share notes very broadly. We'll share information on deals, and we really appreciate each other in that way. But we do compete for investor capital, especially in Canada. So that's kind of the sensitivity. I'm really dancing around your question, aren't I?
I love your politically correct answer of saying there's a lot of camaraderie in the industry.
There is. So look, I'll say our fund is small. We are taking small bites of big CVs. And so when I see who the lead is, there are certain firms where I'll think, wow, that's great. So one of them is like Harbor Best. I think their secondaries team is phenomenal. I have to declare my husband works there, but on the real asset side. But I just think they're great. And when I see them lead a single asset CV, that to me is positive. I think Alpenvest is another group. They don't do the huge CVs, but when I see them lead a deal as well, like I have some ex-colleagues there as well who I think really highly of. So I'm excited about that.
Yes, maybe my question was perhaps phrased incorrectly. I shouldn't say competitors. I should really say comrades,
Yes.
who are kind of driving the industry forward, right?
Yeah. For now, we're friends.
For now. Well, look, just before we wrap up, I'd love to get your take on a few maybe focused transactions that you've worked on over the years, and maybe what's a deal that you're most proud of, and then what's a deal that maybe wasn't as great as you would have expected.
Yeah, I mean it's a young portfolio for now in the single asset CV side. Um, Probably the first deal we did, I think about a lot because that actually kicked off our fund. And it was a deal that came to us, as I said, I knew the GP really well, had seen the asset change hands a few times within the CPP portfolio as well. And actually, when we learned more about the transaction, we started raising our fund. We had a bit more space to do more. So we went back to the GP. And I have to give my business partner credit for this, went to talk to them directly and got actually a direct piece in the deal through a co-investor. And so we were able to participate on a very large amount in the transaction, bringing in a number of different parties, and it kind of anchored our fund. Um, Also, the beauty with some of these deals is sometimes they take a while to close, and this co-investment piece took a while to close. So by the time we got in, the price was very, very good. And today, I mean, it's still the GP has started to back to market, but there's a big delta between where it's held and the comps, and it's already performing very very well without even being at where it is in market value, just from paying down cash. So that's a great one, and I feel like we all kind of came together as a team to diligence that. It's an industry we didn't know a lot about, but I happened to have like family members kind of in it. So I was able to get like a really good view of the transaction. And so going in just felt really like comfortable in that we had done differentiated research. We had a great big slice of the deal with preferred economics. And then anchored our fund. So it was kind of like a great start to our foray in the single asset world. And then ones that haven't done as well, like it's been kind of a tough market, I'd say. And you've had rates go up. So we haven't seen anything like directly underperform yet. There's been some transactions where, and this is the beauty to being with some of these larger GPs, where the growth has kind of slowed a bit. But there's one in particular with a very very large GP where they knew so far in advance, like that their pipeline was just looking a little kind of weaker on one side, but they could pivot immediately and start putting in cost initiatives. And so although kind of growth is behind plan, they're above on EBITDA. And that is the nice thing of working with these strong GPs that have a track record of doing that. They have so many tools in their toolkit. They're able to
And they have the
look at
experience, right, as
yeah,
well, that they're bringing
yeah,
to the table.
exactly. So that really like helps and feeds into my triage process of working with top quality GPs, which is so important because private equity is a long-term game. You're going to be weathering different economic environments. No one can perfectly time the market, so just work with people who've done it before.
Yeah, and I think like looking at something at a single point in time is a completely different perspective than looking at it over the long horizon, right? And I think the patience game is big at play.
Yeah, exactly. And I do get a lot of investors come to me and talk about like, oh, this environment, which obviously is important and you need to think about, but also like we're here as a long-term play. We're here to invest across markets. And I think you have to really believe that your asset class can perform across multiple cycles and have conviction around that, because no one in the world has been able to call the market perfectly, right? Like you're going to get it wrong. That's just kind of a given. So you just, and then I think the alignment is key too. Like if things are going south, are you aligned with the right people? right?
Right.
That's just so
And do
critical.
you have the diversification that's going to help you weather that?
Yeah, exactly. And you look, you could have the best asset in the world, but some event could happen, right? So yeah, to your point, like having the diversification helps you, have that other asset that can kind of help if something goes
Yeah.
wrong elsewhere.
Yeah, no, that's true. And I guess just thanks for walking us through that. And I know sometimes it's a tough question to answer in terms of, what's the worst deal or least favorite deal. But
Yeah.
I think you did a good job of answering that. Well, lastly, I guess before we wrap up, I call this part of our chat sort of the little bragging rights corner. And
Oh.
so maybe what are some of the performance highlights that you'd like to share with the audience as almost like a parting memory, whether that's, recent team growth, fundraising, deal returns, anything that you feel really good about and want to share with the market?
Yeah, I kind of feel uncomfortable like being the bragger, but it's okay. You know what? I'm practicing.
You have permission. That's
Yeah,
okay.
I do feel like tremendously proud of what we've done. Like starting 8 years ago in a market that no one knew anything about, that kind of had a negative connotation. It's actually pretty amazing what we've been able to accomplish. We've been around for 8 years. We went from 2 people to 9 people. We've got over $400 million of AUM. And honestly, raising that first commingled fund is probably the hardest thing I've ever done. And it's a small fund, but it probably is my greatest accomplishment. I think it gives you such a unique perspective in life and finance and private equity. So I am really, really, really proud of that. That is an experience that I will always, always remember. And because it turned out well and we got the fund raised, I look back on it positively, which is nice. So really proud of that. And then, there were so many people when I would go to pitch this who said, like, there's no way you can do this. There's no way you're going to get access to these deals because the first fund is small. We took little small pieces, and that has not been an issue at all. And so now it's nice to go and say, like, look, actually was able to do it. So, and I think about our investors. Like, I hope that I will, and I plan to, but I hope to always like appreciate those that kind of believed in us in the first fund. Yeah, and I do think about them. Like, I do think having, darling, it does. I think about presenting a deal to them, and that is just something that I'm really proud of, and I take really, really seriously. And look, the way we structured the fund is nice as well. There's no J curve. Investors were at a positive return out of the gate. We've had a markup on probably 75% of our portfolio already, which is nice. Looking forward to seeing some more write-ups and realizations. Because ideally, as I said, we're back every year. Investors can just have their realizations and then continue backing us. And then we have a nice little long-term relationship with all of them. But I just feel like so lucky and thankful for everyone who helped us along the way, because no one does it alone.
No, for sure, and I think as the market continues to grow, I'm hopeful that you're in a position just to keep capitalizing on that. And in general, I want to thank you for taking your time to chat with us today. And hopefully, everyone watching walked away with a little bit more insight into, first of all, the fascinating persona that you are, and kind of how you've built the team and how you've built the fund together, and also your introspective insights into the single asset secondary market, and got a little bit more motivated by your accolades to continue and do better in their respective fields. And so thank you for joining us and being a part of this amazing growth market, which I know we're both excited to be a part of.
Yeah, no, ditto, right back at you, Kristina. Like, I'm so glad you're doing this. And it's so nice to chat with you and have other women in the industry. We need more, so working on that.
It's no coincidence that I'm wearing pink and you're wearing red. You see, there's a place to be feminine in the industry, and at the same time drive performance and drive returns, right? And I think just before we close off, that's a parting thought that I always want to spread and just say. It's possible to do whatever you want to do in the industry as long as you're focused, you have the right support. And if you don't have the right support at first, remember, it takes just one person.
It's true. Well said.
Well, thank you, Tori. It's been a pleasure. And we look forward to catching up with you again in the future.
Sounds good. Thank you.
Thank you. Well, everyone, thank you so much for tuning in, and watch the Secondary Link LinkedIn page for updates on our next special guest and, of course, the release of the full episodes. And we hope to see you in a few weeks where we highlight our next incredible woman on Women of Secondaries. Thank you, and we'll see you very soon.